Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Sean Moore and Clare Tarrant from Downing to talk about the Downing Estate Planning Service. Hello, Clare. Hello, Sean. Welcome to the studio. Firstly, could you tell us about Downing and your roles there?
Hi, Jonathan. Thanks for having us. I'm Clare Tarrant and I'm a portfolio director across our asset-backed strategy. I've been at Downing for about 3 years now, and I'm responsible for the ongoing portfolio management and valuations of our asset-backed strategy. So I started my career at KPMG for 5 years, where I qualified as a chartered accountant before moving to CVC Credit Partners and now Downing.
Okay, and Sean?
Hi, I'm Sean Moore. I'm an investment director in the energy team at Downing. I've been with the business now for nearly 8 years, and I lead our UK energy investment activities, as well as being the main lead on our E&I strategy for the estate planning service. Prior to joining Downing, I spent a few years with the Green Investment Group, and I've therefore been investing in renewables for over 10 years.
And so we're here to talk about the estate planning service. What does it aim to do for investors?
So the Downing Estate Planning Service is a discretionary managed portfolio with 2 key objectives. So the first is that it holds business relief qualifying assets, and the second is that it's delivering steady, sustainable returns with a focus on capital preservation and downside protection.
And so what does it invest in?
So it invests in a diversified portfolio of assets, and effectively you've got the asset-backed strategy, which Claire is involved in, and the energy strategy, which I'm involved in. On the energy side, our primary focus is investing into core renewables. So think solar farms, wind parks, hydro assets. Over 90% of the portfolio is operating core renewables, producing energy every day. We then complement that with flexible assets like batteries that can be there when the sun's not shining or the wind's not blowing.
Good. And that's Bagnall, that strategy.
Exactly.
And then Pulford is your domain, Claire.
Yes, in the asset-backed strategy, we take a thematic approach to investing. So that means we're looking at what's going on in the wider environment and longer-term trends driven by social, economic, and technological changes. So there are some thematic drivers which are increasing the size of our market. So those are things like the aging population, increasing diagnosis rates, government funding pressures, and the ongoing shortage of suitable housing in the UK. And then there are also some thematic drivers which are changing the shape of the market. So the nature of the services are evolving. And those are things like increasing regulation, technology adoption, and the government's transforming care agenda. And so these macro thematics mean that we invest in needs-based sectors. So we focus on healthcare, education, and housing. And these all have large unmet demands over a long period of time, so support us in delivering our mandate to our investors. And these sectors are typically less correlated to economic activity, so they're more resilient in a recessionary environment. And that means that across the portfolio, we see less volatility and more longer-term stability. So we invest in and manage a portfolio of elderly residential care homes, specialist care homes, specialist educational needs schools, children's day nurseries, and funeral care.
So what are you looking for when making new investments?
So I think if there is one theme that unifies both parts of the service, is that they're evergreen funds, and therefore you need to invest into assets or projects or companies which are going to be supported by governments over multiple terms. So whether that's renewable energy, elderly cares, nurseries, clearly that's a necessary part of the economy and is supported into the long term. So that's a starting point, something that you can invest into with a long-term horizon in mind. On the energy side, our focus really is on those core renewable assets. So we like to buy assets that are operating, that are producing energy from day one. And our real focus there is trying to buy high quality, well-built assets. And if they've been operating for a number of years, you can look back at the production, you can evidence how they've been performing, and you can really focus on ensuring you're buying a quality asset that you're happy to own for a number of years.
And similar on the Pulford side, I imagine, Claire.
Yes, there are various attractive characteristics we look for in the businesses that we invest in. The first is that we look for businesses operating from freehold property. So it's in the name of our strategy, asset backing, and that provides an additional layer of downside protection. So that if something were to go wrong in the operations of the business, we have that tangible asset to lean on. So there is value recoverable in that bricks and mortar. We also look for businesses generating steady and predictable cash flows because that provides sustainable long-term income. And that matches with the steady returns we're targeting for our investors.
So typically non-cyclical cash flow generating assets.
Yeah, exactly. These needs-based sectors. And we're also looking typically for businesses operating in fragmented markets, because that means we can start low risk, start small, build big. And there are lots of value accretive investment opportunities for us to acquire individual sites or smaller groups to build our platforms. We can then improve them and scale them up. And I think with the team's really strong track record in the sector and their expertise, we really are able to support these businesses in generating real value. So we can do that by creating efficiencies, building profitability, and implementing institutional standards. And these are things that typically smaller businesses can't achieve alone. And we're able to invest across the capital structure. And the flexibility in how we can provide that financing is very attractive to strong management teams. And it also means that we're not reliant on external debt markets. And our deals are not structured like typical private equity deals. So there is no third-party leverage ranking ahead of Pulford's capital. And whilst we invest across the capital structure, we put the vast majority of our money in a fixed return shareholder loan position with pinhead equity, where Pulford can participate in the upside from strong performance.
What does pinhead equity mean?
We'll put a very small amount of money in there. So if our performance is above our fixed return, we'll then get further upside. But we obviously have greater security in the fixed return shareholder loan position. And it means that our investors in Pulford get all of their capital and fixed return back before management or any other party make a return.
So who's managing the assets and who's making the investment decisions?
So we like to we partner with some really strong management teams who will have demonstrated a strong track record in the sectors they operate in. And we also require them to invest alongside Pulford, so they have skin in the game as well. This means that we're aligned and they're also incentivized to perform well. And in our lending vehicle, we partner with small and medium property developers in the UK who will have a strong track record in their local property markets. So there we're typically lending from 2 to 30 million in a facility, but I think the sweet spot is probably in the 3 to 7 million range. And we have over 85 facilities in the loan book, so that is highly diversified. And the team have been investing in that space for over 8 years, investing over 500 million with a really low default rate of under 2%.
So you're typically investing alongside an external management team. You'll acquire some care home assets and there'll be a management team that might have done it before and you'll invest alongside them.
Exactly that. So we might have a team that has got a strong track record already, or we may in some cases have a majority owned platform where we have kind of pulled the team together ourselves from people in our network. Yeah. I know that's different on the energy side.
What do you do on the energy side, Sean?
So on the energy side actually is very different. We actually manage all of our assets in-house. What we have found is that we need to ensure that assets are performing incredibly well day in, week in, month to month. And we do that through having an in-house asset management team of 30 plus professionals based across London, Glasgow, Sweden, and Finland. Those are teams on the ground, people who can really look at how the assets are performing, manage the operating partners, and make sure the assets are always available, always being very efficient. They do that primarily through high quality data and reporting. So every single day they'll process thousands of data points from the assets. And if there's any issue, get on the phone very quickly, make sure the asset's back up and running again within the same day, manage your availability, manage your performance.
So on performance, how has the service been performing? And is there competition between the two companies?
Oh, there's always competition. I think if you look at our kind of target return, we aim across the service to hit 3 to 4.5% as the level we're aiming for. Over the last 5 years, up to April of this year, our return was 4.7%, so actually just above our target return. If you look back across the life of the service, then we're at a 3.46% combined return over the course of that time.
Very good. And has the performance been affected by recent market volatility at all?
So when we think about the markets on the energy side, we're really thinking about the energy markets. And over the last number of years, those markets really have been quite volatile. As everybody who has an energy bill knows, prices have been going up and down over that period of time. We're trying to preserve capital, we're trying to manage risk. So how we do that with our portfolio is we try to ensure that a lot of the money we make actually isn't from selling energy, which sounds quite strange as an owner of energy assets. What we do is we make money from subsidies. So that's a fixed price per unit of energy generated on some of our older assets. On some of our newer assets, we're entering into new long-term contracts with investment-grade counterparties. So we have on one asset, one of our larger solar assets, a 15-year government contract, inflation-linked, where we're paid a fixed price for the energy and don't have to worry about how the markets go up and down in that period of time. We've also signed some very long-term power purchase agreements with investment-grade off-takers who are buying the power locally on 25 to 30-year contracts, again, inflation-linked. So for those assets, again, there is zero exposure to the energy markets.
So these are corporates?
So on that side, exactly, they are investment-grade corporates.
So Sean, how easy is it for investors to take their money out? So they've had their returns. Is it easy to sell?
We try to make that as easy as possible for our investors. So therefore we offer liquidity on 10 days notice, subject to their liquidity being available. That is done on the first day of the month and the 10th working day of the month. Over the course of the life of the service, we have had no issues at all in terms of providing liquidity. And in terms of how those investors get their return, because we charge no dealing fees or no exit fees, the return they're expecting to get is the return they'll get when they come out of the service.
So how risky is the service? We've spoken about buying asset-backed cash generative assets, but these are unquoted investments. How risky would you say the service is?
Well, obviously, it's not possible to eliminate all risk, but as the core of our job as investment managers is to ensure we are understanding and managing those risks and mitigating those across the portfolio where we can. And risk management really is embedded across all of our processes throughout the investment process and also ongoing portfolio management. But a key aspect to risk mitigation is the diversification of our portfolio. So across the wider DEPS, we have over 9,000 assets across over 14 sectors. And that is more than any other BR provider in this space. But there are many layers to diversification beyond the sectors. So within our healthcare and education businesses, we're interacting with different demographics of society. But we also diversify across different management teams, different stage of the investment cycle, and different geographies. So we have sites located all over the UK and in the Nordics for their energy and infrastructure strategy. And we also diversify our revenue streams. So within the asset-backed strategy, we'll have service users who are private pay and also service users who are public pay. I think people typically think of government funding as one big pot of money, and that really isn't the case. So there are hundreds of different local authorities, each with their own pot of money and independent decision-making responsibilities. So we always ensure we're not overexposed to any one funding source.
Very good. And Sean, on the energy side?
On the energy side, our aim is to keep things as boring as possible, essentially, is the aim of the game. So by investing primarily into operating assets, you're taking less construction risk, you're buying into things with proven track record that you can prove have performed over that period of time. The next thing we do in terms of, again, diversification is by investing across solar, wind, and hydro. You have a year where the sun's not shining as much, or the wind's not blowing as much, or there's not enough rain to power the hydro. Those things are not correlated. Actually, they're negatively correlated. And therefore, if you have an issue in one part of the portfolio, very likely another part of the portfolio is more than making up for that. What we then do is wrap around our asset management team to make sure the assets are performing very nicely, no issues there. And then finally, it takes you back to that point around the energy market risk. If you're making a good portion of your money through subsidies and fixed revenues, you're less exposed to those risks around the energy markets. And I think actually when you then look at the two portfolios combined, with their slightly different trends and different factors sitting behind them, and look over the life of the service, we've only actually had 1 year where performance has been negative. Unsurprisingly, that was 2020. In the heat of the COVID pandemic, we did suffer negative performance across the service, but that was only 5% across the two portfolios combined. If you compare that to the wider market where equities are down around 30 to 40%, we've shown that by investing into necessary assets on the energy side and on the asset-backed side, you can really manage those dips in the macroeconomy and recover strongly thereafter.
Very good. And so with this service, there are 2 additional insurance products that are, I guess, reasonably unique to this service compared with others. Could you tell us about these?
Yeah, so the first is the optional life cover, and that covers the inheritance tax liability on an investment during the 2-year qualifying periods. That is available to investors who are under the age of 85 at the point of investment and is subject to some medical underwriting and an insurance premium. But the second is the Downing Wealth Card, and that is a unique feature offered exclusively by Downing at no extra cost to our investors. So that just provides an additional layer of security for our investors. So that can cover a fall in valuation of up to 20% in a scenario like COVID, where we dropped 5%, that would have been covered. And that is included in our charges already and is available to all investors under the age of 90 and includes no additional application form and no medical underwriting. So whilst the service is already structured to provide capital preservation and low volatility, this downside insurance just provides that additional layer of reassurance for our investors.
Very good. And so finally, to sum up then, for those who want to invest in an inheritance tax service, why should they consider Downing?
I think from my perspective, actually, it's the same process you go through when you invest into any investment product. So my checklist generally is investment performance, And clearly here, the estate planning service has performed very well consistently over time. The next thing is risk. We've spoken a lot about diversification, a lot about robustness to macroeconomic movements. And our view is that this is a portfolio very, very protected from material risks. Thirdly, then you're looking at kind of value for money. And we believe our fees are competitive, they're very transparent, and compare well with our competitors in the market. The fourth is actually basics, customer service. We have an in-house, high-quality customer service team. So if you have issues and queries, you can reach out to us directly, and we can deal with those issues. And then finally, it's kind of, are there any nice added extras? And we believe that our insurance products are that added extra, that bit of extra value for money that really can draw you back into that service.
Very good. Sean, Claire, thank you very much.
Thank you.
If you're watching on YouTube, please press like or subscribe to the channel for more.